Tuesday, February 10th, here's the rundown. We have about an hour to go in the market and things are flat. The S&P equal weight is outperforming the S&P. We talked about that yesterday, and that representing the rotation into the value trade away from the growth and technology a little bit. This morning, we had retail sales report that missed expectations for December, which means that that is less growth for the US economy. And remember, the economy is 2/3 of the consumer. You and I are 2/3 of that. So that was a little weak in December. Higher prices meant that there was less spending for Christmas and the holidays. And today, software has outperformed the semiconductors, and so there's a little bit of a bounce happening there. We'll see if that lasts. Also, Alphabet, otherwise known as Google, since yesterday, they have doubled their debt raise. They are raising not 15 billion, but 30 billion. So that question remains as far as the cash flow of the super big tech companies. And, generally today, it was kind of a blah day. Again, things are, a little bit flat, and the ticker tape is soft. It started in the green and has kind of fizzled off into the red and a little bit flat. And so on days like today, when there's not a lot of really significant moments and events and news, I like to do deep dives and spend my time looking into today. I wanted to check out some risk on and risk off indicators. So we've talked about that. Risk on is when people are really in the market and have their money in the market, versus risk off when they're feeling more cautious and taking their investments, taking that off and staying safe. And so the safe trade so far this year, I did a deep dive into that this morning, and the quote safe trade is outperforming this year, with staples and dividend stocks doing better than those growth stocks that we talked about. The risk indicator of Bitcoin is down about 2.5% today, and over the last 4 months has lost over 45%. And interestingly enough, the younger generation, Gen Z, and a little bit of the millennials are opting, instead of Bitcoin, they are putting what they consider to be the more risky part of their portfolio or their trades into the prediction markets, the betting markets like Kalshi. So they're going there as more of when they want to take a little bit more risk. I find that to be anecdotal and but interesting nonetheless. And so yesterday, the rotation into value stocks that we talked about is continuing to show its persistence and stickiness. And that's significant because, again, like we talked about yesterday, it's tried over the last 3 years 5 or 6 times to make that move, but this time it's proving to be a little bit more durable. So let's talk about risk forecast. For the risk forecast, I like to watch credit spreads between US Treasuries and corporate bonds. Um, and that is, are people, the differential between people buying US Treasuries and corporate bonds, okay? When they sell those corporate treasuries and buy more of the US Treasuries, that indicates a little more caution, or a lot more caution, because the US Treasuries are always still considered to be the safest trade, the safest place for your money other than cash, and that the US has never defaulted on its debt. Instead of corporate bonds, which can offer a little bit more yield but are definitely more risky. People don't have the same confidence going down, going into the future, that corporations are going to continue to be as reliable in paying back that little bit of higher yield. So they opt more for the safe trade. And the bond market is often called the smart money, which is we can debate that, but definitely the bond market, interestingly, is bigger than the equity market. So our stock market worldwide is smaller than the bond market. The bond market is, where companies and countries go to raise money, and so the bond market's actually bigger, and they I think they call it the smart money because credit investors have a longer time horizon, and they need to get paid, make sure that they're paid back on those loans that they're making to the US government or other governments or US corporations. And they have to be conservatives, be conservative, because those investors are not only individuals, but there are a lot of pension funds and 401ks that have a fiduciary responsibility to make sure that they are making the safer bet. And so they have a much longer time horizon and are much more conservative. And so I like to look to the credit spread between the US Treasury and those corporate bonds as far as when that starts to move significantly, and it's making some moves now that shows me that there's more caution that's putting the weight into the US Treasuries and out of the corporate bond. And so after that retail report this morning, the US Treasury price jumped higher, and significantly higher. And what that means is that when the price goes up, oftentimes you'll see the yield, let's say the US Treasury yield, like this morning after the retail report, the yield was down. So you'll often see US Treasuries expressed in terms of the yield, the percentage. That's down. When the yield is down, the price is up. In other words, people see that report on retail sales, they get a little bit concerned and they buy treasuries. When they buy treasuries, okay, the US government that is selling that debt doesn't need to offer as much incentive. So the yield that they offer goes down because people are buying it. And then the opposite is true. When not enough people are buying bonds, again, let's say the US Treasury, that the price will go up. I mean, the price will go down and the yield will go up because the US needs to attract more buyers for it. So you'll see that again expressed in yield, and that will be green and up because they don't have enough buyers, so they need to offer a greater interest rate on those bonds to attract the buyers. So I hope that's interesting. That's kind of, I don't know, a little bit wonky. Instead of showing the price, they show the yield. So just to recap that this morning, the yields were down because people were buying the bonds. And so there you go. They didn't need to offer as much as a return on those because people were buying them anyhow. So the well, that's pretty much it for today, you guys. I want to keep it simple. And so to sum up, the safety trade is staying strong. Investors are seeking the slower growth, companies with more proven performance, and those that have a really reliable dividend. So safety is the theme since the beginning of the year. So there you go. That's it for today. And please remember, like we talked about, when it comes to your money, preserve it, protect it, and then make it in that order. All right. Take care. I'll talk to you tomorrow.